Welcome back to Overnight Accountant's course on Realtor and reducing taxes. In this section, we're going to continue discussing the auto vehicle car expense deduction, which I believe is line 9 on your tax return, on your Schedule C rather. This section, we're going to discuss two very important items. We're going to discuss record keeping, and then we're also going to go over the standard mileage rate deduction, which is one way you can deduct your mileage on your vehicle. It's the simplest way to do it, and actually most of you will benefit both in terms of record keeping time and in terms of your deduction from using the standard mileage rate. So we kind of put all those together into one little section here. So let's go into this. Let's talk about auto record keeping. And auto record keeping is essential if you want to, good auto record keeping I should say, if you want to substantiate your deduction, to keep your deduction if you're looked at by the IRS. And what they're going to want to see is must be able to prove several things. You're going to must be able to prove the date of each business trip that you're claiming the deduction for, where that business trip started, where that business trip ended, the number of miles driven on that trip, the business purpose of that trip, which is very, very important as you show why you made that trip and how that relates to your business, not just the miles driven. And also you're going to need to record your commuting miles and your total miles each vehicle was driven for the year. Now remember, all these record keepings are for each vehicle that you use for business purposes, so you need to keep separate records for each vehicle. Commuting, as we discussed in our last section, if you want to go back to it, you know what that is. That's basically commuting to and from your real estate office if you don't have a home office, and it's pretty much always to another job you may have from your home. That's really commuting expense. Okay, we're going to go over a couple different kinds of logs here. The first one's going to be what I call an ideal contemporaneous log, and this is really where you track every single mile driven for business, and you do it in a very thorough and methodological way. So this is an example here. This is a log you can download. We may have one for you on our resources section on the website. Go ahead and check that out and see if we do. We probably do at this point. Now this here shows your date, the day of the trip. Now this is where it kind of becomes a hassle because they want you to record your beginning odometer reading and your ending odometer reading. And of course the difference there gives you the miles traveled for the business trip. And then here you can even put in your business purpose and destination. You put to, from, and why you went in this section here. So it's very, very helpful, very handy. As you can see, it's a little time consuming. You can also buy these logs at pretty much any office store. You can download them online. You want to keep one in each car. So it's important you have a separate log for each vehicle. Now also you can download many apps and programs that will assist you in tracking your business miles for your business. And you can do that manually by entering it by hand, or also many of them now will also just track your GPS. You just type in where you're going and where you're coming from. And maybe even now as you're watching this, they're probably even more user friendly. So they probably have some by now that sync the Bluetooth in your car and everything like that. So it's very, very handy apps. If you have one, please share it with others. Let them know which one you like the best, which ones work for you. Now this is a big deduction. So this is the largest deduction for most realtors is going to be your auto expense. So it's very important. We don't want you to miss any miles that you could deduct. And if you deduct those miles, we want to make sure you can prove them. So it's very important. Now here's another log method that hits all the main points of the ideal, but it's also a lot easier to do. So if you're not really good at remembering to write down your odometer reading every time you get in the car and to fill that log out every time you take every single business trip, this will work. It's functional. However, if you use this method, you'll be able to substantiate the deductions that you actually claim. However, in my opinion, my experience working with a lot of realtors, it works for them. However, they almost always will lose some trips because they just forget to record them and they don't follow the process for every single business trip they do. So doing this, the functional mileage log, what you want to do is every January 1st, you just have to remember to write down your mileage on your vehicle every January 1st. So that'll give you the beginning of the year, end of the year. That'll give you your total miles for the year. So you'll have that taken care of. And let's just say you start the business in the middle of the year. You want to start whenever you start using the vehicle for business, or if you're new to real estate, whenever you started in the real estate business, started using that vehicle. So what you want to do here is you want to print your directions in mileage. So you go online, you either use MapQuest or Google Maps, and you actually print the directions for all the main trips you may make for different property listings. So let's say you've got some properties listed. You in your area. If you have a home office, you want to like go into Google Maps and type in your home and then the property address, and then you print that out, and that'll give you the mileage. It'll also give you directions to get there. But what we're really after here is the mileage. And then so you do that for all the trips that you may take on a regular basis. So if you go on a regular basis from that listing to the real estate office, print that out also. Print the directions for that. That way you have all the mileage taken care of. So you also have proof of that mileage, how the trip is. So so you have that taken care of by doing that. That base is covered. Now, include printouts for common trips, as I said, the properties between your home and your office. And then what I want you to do is I want you to keep a daily schedule showing the places that you visit. This could be your calendar, whatever you use to track what you're doing every day. You keep a daily schedule showing, you put it right in your phone, however you do that, the places visited, to, from, and who you met. So that'll also show by tracking who you met. That'll also help you know why your business purpose in doing that. So keep a daily log, and then you use that schedule on a regular basis. Hopefully you're not waiting until the end of the year to do it, but on a regular basis, you physically put those into another log. You fill out some type of log that will allow you to track your mileage so you can total it up. So you have all your bases covered with that. Now the challenge of this, of course, as I mentioned earlier, is you're probably going to miss some irregular business trips that you didn't record. So you want to just be, if you're really aware of that fact, the way you're tracking your miles, it may remind you to make sure you record those business miles in your schedule or whatever you did for additional trips. Now, the fact that you're going to lose some of these is really why tracking starting and ending miles every day in the locations visited is preferred. It gives you everything you need, but it is very cumbersome, and it's very hard to remember if you're running somewhere to get to a meeting to stop and write down your beginning odometer reading. We know that's not the real world we live in, so this functional log actually will help you at least not lose a lot of miles, and it's a good happy medium. But ideally, the ideal log we discussed earlier is what you want to use. Now here is the risky mileage log that many clients I've had over the years use. And basically what that means is they recreate their mileage log at the end of the year because they didn't track their miles properly during the year. This is accepted by the IRS, but it is highly, highly scrutinized, as you can imagine. If you don't have any physical proof of where you went, why you went, the date you went, it's very likely the deduction will be disallowed if the IRS ever looks at it. Plus, you're not going to be able to remember everything. Now, and also, if you don't have any written evidence to prove your mileage, you really shouldn't be taking the deduction at all. So you do need to have some kind of log. The risky mileage log is hopefully you have a calendar or something that you can go back and reconstruct your miles that you drove. You have some kind of physical proof, but you don't have any written evidence. The IRS is pretty much going to boot at least a lot of the miles that you're probably claiming. Now, the bottom line here is it's a big deduction. It's your biggest deduction, and we want you to track it. Remember, every 1,000 miles is going to equal $500 to $600 in deduction. That's going to save you, depending on your marginal tax rate, every 1,000 miles is going to save you somewhere between $150 and $260 in savings. For most of you, it's going to be upwards of $260. So it's worth tracking the miles. That's it for that section. Let's start into deducting auto use. We're going to introduce how to deduct auto use in this section, and then we're going to dig into standard mileage rate. So calculating your auto expense, there's basically two deduction options for calculating your auto expense. One's going to be using the standard mileage rate, and the other is going to be recording actual expenses. Regardless of which method you use, remember both these are based on the vehicle, and they both require a mileage log. So the benefits of standard mileage rate is it's really simple to do. All you really need is that mileage log. Now the actual expenses are a lot more complex and time consuming, and in the section we discuss that, which is going to be a separate later section, and we're not going to cover every little aspect of the actual expense, but we're going to go over what you need to do to get the most out of that deduction. Also, you'll see here that this section we're discussing the standard mileage rate. If you know you're going to use the standard mileage rate, you can actually skip the actual auto expense section, which is fairly complex, time consuming to do, but for some realtors it will benefit them. You can sometimes switch between the two methods, which we'll discuss when you can do that and when you can't. So right now let's go into the standard mileage rate. Standard mileage rate As I said earlier, it only requires that you keep the miles to claim this deduction. It is great for part-time agents who use the car for other purposes. It's great for agents who use economical vehicles that don't have, that have good gas mileage and aren't real expensive. Also, a big factor in here is the reason I prefer many of my real estate clients to use a standard mileage rate is you got to consider your organizational skills and also the value of your time to track every single expense associated with each vehicle you use for business. It's almost like a separate bookkeeping setup you need to have if you're going to use the actual expense. Now, in order to take the standard mileage rate, you must use this standard mileage rate in the first year that your vehicle is available and used for business, or you can't use it in a future year. So if you have a vehicle you're starting to use for business, you don't use it the first year, you don't use the standard mileage rate, you're barred from ever using the standard mileage rate. So a good thing to do for many realtors is to use standard mileage rate the first year, and that way you have the option later. Standard mileage rate the first year can generally switch between methods in later years. You can't do that with leased vehicles. We'll discuss that in a separate section. However, with leased vehicles, if you use standard mileage rate once, you got to use it through the whole lease term. You can't switch. Also, if you use the standard mileage rate the first year, then you switch to actual, which we'll discuss in a separate section. One thing I want to make you aware of is you must use straight line depreciation when using actual expenses to switch back to the standard mileage rate. We'll discuss that more when we talk about actual expenses. Using standard mileage rate, as I mentioned a moment ago, first year gives you a good option to switch later if you find that more beneficial. So how do we report standard mileage? You must use the standard mileage rate, as I said, the first year you use the vehicle. Standard mileage rate changes. It changes often. It's usually between 50 and 60 cents, but it changes each year. A lot of times it'll change in the middle of the year. So, for example, for 2017, it's 53.5 cents per mile. 2016, however, it was 54 cents. So it usually hovers around that 55 cents, somewhere between 50 and 60 cents a mile. What you want to do, if you're using software, it'll figure it out for you. If you're really interested in what the rate is right now, you can really Google it, go to irs.gov and check it out. Now, it's relatively simple to claim the standard mileage rate. You really just basically multiply the business miles by the rate per mile for each business vehicle. We'll also need to report commuting and personal miles. So remember, your mileage log, if you're tracking your beginning miles, beginning of the year and end of the year, you'll know the total miles, and often you can back into whatever commuting miles you had during the year if you're using the functional method that we discussed earlier. You know, how many times you go to the trip, you go to the office on average, that was commuting, times the number of times per week, time per year. That's how you arrive at that. So start tracking your miles on the date you start to use the vehicle for business. And now, if you're using standard mileage rate, in addition to the standard mileage rate, you can deduct several things. One of those, you can also deduct interest on your car loan based on the percentage of business use. That's why it's important to track the total miles for each vehicle during the year. So let's say you had, your percentage of your business miles for one of your business vehicles, say 60%. Well, that's really good. That also means you can deduct 60% of the interest on that car loan can be deducted on your tax return. And also same with your property taxes. So 60% of the vehicle is used for business. You can deduct 60% of your property taxes in addition to the standard mileage. Also remember that business tolls and parking are also deductible. Those are generally deductible as a auto expense or as a travel expense, but remember to track those if you can, because they all add up. However, this does not include tolls for commuting, or it also does not include office parking for parking at your main office. And it does also not include fines and tickets. You cannot deduct fines and penalties under law and tickets really anywhere on your tax return. So just keep that in mind. Software, if you're using software, just remember to enter it properly on the auto screen. If you're hiring a professional, make sure they know. Make sure they know about your mileage. Make sure they know about these other expenses, your interest in your property taxes, because they may not ask you. So that's one of the good things about this course is if you're working with a professional, this will help you maximize your deductions, particularly during tax season, because these folks are busy and they're not going to ask you every single question. Many of them won't, about what could potentially be deductible. Now, depreciation, I want to make sure you're aware of this too. This is where this can get kind of complicated and why we really like our students to use professionals when they do their taxes. However, I know many of you guys are doing it yourself, which is fine, but I want to make sure you're aware of this. Depreciation is included in the standard mileage rate. And it does change from time to time. For 2015 to 2016, 24 cents per mile out of that 53.5 cents is considered depreciation. Now what that means is your vehicle is depreciating, you're expensing part of that vehicle in this standard mileage rate each year. And this is why you want to keep track of your business miles driven for each and every year you use a particular vehicle for business. Or if you use software, make sure the following year you use the software, it carries forward your business miles from one year to the next. Some versions of it do, some types of software don't. So it's important you track that manually and keep track of it. Because the reason for this is it may create a taxable event if you ever sell your vehicle and trade it in. I want to give you a quick example of that. Let's say you pay $15,000 for a vehicle. You drive it 50,000 miles for business during the years you own that vehicle. So your depreciation on that vehicle is really you take 50,000 miles times 24 cents a mile. That means you have written off, you've in effect expensed $12,000 of that $15,000 vehicle has been written off through all the miles you've been able to deduct on your tax return. This gives you what we call a basis, and that's a kind of a tax lingo. It means your remaining investment in that vehicle is $3,000, and to get that you take your $15,000 purchase price minus your $12,000 of depreciation, so that gives you a basis of $3,000. So let's say, for example, you later sell this vehicle for $6,000. You sell the vehicle for $6,000. You then have a $3,000 taxable gain from the vehicle, and that is really the $6,000 minus your remaining investment, your basis. That gives you a $3,000 taxable gain that you are really required to report on your tax return. So, just want to make sure you're aware of that. Many folks forget that when they sell their vehicle or trade it in, but it's important that you keep that in mind. It's the reason we need to keep the total mileage. So, how do we go about reporting standard mileage? I know many of you guys are using a professional, which again is preferred, or you're doing your own tax return on software. We're going to go over where this shows up on your tax return just so you know where it goes, and if you're going to look at it on your tax return, how it is actually reported on your tax return. It is reported on Part 4 on page 2 of your Schedule C. Here, that's what it looks like. Now if you look at page 2 of the Schedule C, you'll see the part there for Part 4, information on your vehicle. Now if you have more than one vehicle you use, it'll show up as your software will print out a separate schedule for this. However, using one vehicle, this is where you'll see the mileage show up if you're using standard mileage deduction. And let's go over each section here. See line 43. That's where you have to enter the date you started to use your vehicle for business. Now it could be not the beginning of each year, it could be a prior year, whenever you started to use that vehicle for business. Now you notice on line 44 right here, there's several items you need to enter, and this we want to know your business miles, which if you're doing good record keeping, you should be easy to calculate for each vehicle. Your commuting miles, which is really, if you look at the earlier section, to define what commuting miles are, and then other. So that gives you your other miles driven during the year, which is basically non-business miles and non-commuting miles. So you add all three of those up, that would be your total miles for the year. So total miles, C is total miles minus A and B. Okay, here we go. This is where some of these questions get pretty important, that you understand what you're answering and why you're answering them. And if you're going through the software, there'll be a section where they'll ask you this. Was the vehicle available when you're not working? Okay, they wonder if that particular vehicle was available when you were off hours. Most of you, sure it was. But then they want to know, do you have another vehicle for personal use? And some of these are kind of trick questions that the IRS is asking you. If you have do you have another vehicle available for personal use? And if you answer no to that, there's no way, they know there's no way that you can claim 100% business use for a vehicle if your spouse or someone else, you don't have another vehicle that you can use. That's the reason they ask that question, is to see if you're claiming 100% or somewhere close to 100% for that vehicle and you don't have another one available, well, you just kind of told on yourself. And if they look at your return, which it may increase the chances by stating that. So hopefully you have another vehicle available so they don't deny your deduction or some of it. So That's it. Now I have two other questions. And this is kind of like the 1099 questions we asked earlier. I told you we're on the return now about did you make any payments that require 1099 or not? And then if yes, are you going to file your 1099s? So 47A, I'm sorry, it's a typo there, 74, but 47A, do you have any evidence to support your deduction? You want to know if you have evidence to support your deduction. And then if no, how did you calculate it? So if you don't have any evidence to support your deduction, why are you claiming the miles driven? So they want to know that. And then in 47B, they want to know if yes, is that evidence written? So they want to know if you have a written log or some kind of physical evidence to prove your mileage deductions, because so many people don't. And they're asking you this on the tax return. Remember, you sign your tax return under penalties of perjury. So they're asking you if yes, is the evidence written? If you don't have any written evidence, how can you prove your deduction and why are you taking this deduction? That's why these are kind of the two tell on yourself questions. So what you want to make sure here, these are gotcha red flag questions, be able to answer both of those questions honestly, yes. And hopefully from taking this course, you have some type of way to substantiate your mileage. So that's it for this section. In the next section, we'll be discussing actual auto expenses, which if you know you're claiming the standard mileage rate with your vehicle, which we just discussed is really the simplest way to report your mileage on your tax return, you can probably actually just skip that next section and go on to the following. But thank you so much.